everyone. Just to let you know my background, I manage the mortgage originator team here at Chelsea Groton Bank. Our branch managers take mortgage applications, and we also have a team of 11 roving loan officers who are just out there trying to develop business under the Chelsea Groton brand. And those folks report to me. I've been in the business 25 years. And everything we do tonight is really generic kind of mortgage 101 type stuff. And I apologize if anyone walks away without new information, but that rarely happens. Typically, there's some nugget in here that can help you in your journey, but everyone's specific situation is very specific. So this is not a pre-qualification seminar, although we do tell you how the numbers work in this seminar. But we do encourage you to make an appointment to sit with a loan officer and talk about your specific scenario and how you can best prepare to buy a house either now or in the future. So I always kind of say that to people. Everyone's situation is very specific. There is no cost or obligation to sitting with us and talking about your specific situation. So it shouldn't prevent anyone from doing that extra exploratory work, but I think you'll get a lot out of today. To Miria's point, if you have questions, flag us down and we can answer them on the spot. The seminar never usually goes the full hour. So we have time for that, or by all means, you're free to email me after or throw stuff in the chat and we'll get you the answers you need. I think at the end we do highlight my contact information, but just in case, my email address is mmorrell, mmorrell @chelseagroton.com, and my phone number is 860-448-4167. And if maybe if you throw it in the chat that you didn't quite get that, Miria can chat it out to you. But always available to answer specific questions. All right, so with that, we're going to jump right in. First of all, you know, buying a home is a big decision, despite what maybe the television sometimes leads you to believe, that it's a quick click of a button and you're happy forever after. It is a lot of responsibility, both lining your ducks up to make your first home purchase and then owning the home throughout the life of your ownership. There are both risks and rewards. We're not here to say everyone should own a home, because that isn't the case. It's never been the case. And of course, it is a long-term commitment. Most specifically, you know, you typically enter into a long-term loan for a mortgage, although don't let the numbers fool you. The average 30-year fixed loan in the United States is on the books for about 7.5 years. People tend to move around a lot, or they refinance for a variety of reasons, or if they're fortunate enough to pay the loan off, people try to do that earlier than later to save some money over time. So it is a long-term commitment by and large. Let's talk about buying versus renting, pros and cons. Currently, interest rates are historically low, so you can borrow money cheaply to buy a home. There are reasonably priced homes on the market. I will say that we are in the midst of a bit of a frothy market, particularly along the shoreline. COVID-19 has affected the world in a variety of interesting ways, not the least of which is people's migratory patterns. And we've got folks who now can work from home who have decided to move to places where they otherwise wouldn't have moved if they had to commute to the office. It's kind of a weird phenomenon that you can actually Google, because it is a real thing. And we are feeling it along the shoreline particularly. There are tax advantages to home ownership, and you build equity, unlike when you rent, where you don't build any equity, you just pay your rent each month. On the rental side, there is no equity building. There is typically no tax advantage. You know, your landlord ultimately has the last say over any property improvements. They could very well decide not to rent the unit to you upon renewal of your lease. So there's some exposure there. And of course, rents may increase at the whim and whimsy of a landlord. So you have little control over that, at least with a mortgage. But for your taxes and insurance, you know what your monthly liability is at all times. I say but for your taxes and insurance, we'll talk more about that, but obviously those are parts of your home ownership that can adjust over time and typically will. So what makes up your mortgage payment? If you're accustomed to paying rent, you pay your rent, and that allows you to live in the property for the following month, right? So on March 1st, you pay to live there in March. Your mortgage payment is made up of a few more odd items. There's your principal and interest, which is the actual payment to the bank what you owe us as your lender. Your property taxes, every property in Connecticut and in the country has property taxes that you pay to the state and federal taxes. Homeowners insurance, you always have to carry insurance, of course, on your property once you own it. Homeowner association or condo fees, if that's what you're interested in, as a condominium. And finally, mortgage insurance. We'll talk more about mortgage insurance, but when you put less than 20% down on a property, you have to buy an insurance policy that insures the lender against loss. It does not insure you as the borrower against loss. Then why would you pay for it? Well, because it allows you to get into a home with a lower down payment than we would otherwise require of you. So more on that to come. I hope my pace is okay too. I've lived in Connecticut since 1995, but I'm a Long Islander originally. So sometimes my syntax gets away with me and I start talking pretty quick. So if that's the case, flag me down in the chat and I'll slow it down. Other expenses to consider besides what we just described, which by the way, the shorthand for everything on the prior slide is PITI. PITI is P-I-T-I, property insurance, taxes, and principal, interest, taxes, and insurance. So in addition to your PITI payment, when you own a home, of course, you have repairs to the property, you have your utilities, your lawn care, your maintenance, your water and sewer bill, if that's applicable, and then all those miscellaneous things that come with owning a home that you may not be accustomed to when you're renting an apartment or even a house for that matter, because typically all of this stuff comes under the auspices of what the landlord is responsible for. And the whole idea of this is we want you to go into this eyes wide open. We're not here to put anybody in a home that they can't afford and stand the chance of losing. So this is an eyes wide open exercise just to make sure that you're mentally prepared for all these things that are involved in home ownership. So how do we determine who we're going to lend to? Well, it's not at all subjective. It's pretty objective, as a matter of fact. And the three things that we really look at are what we call the 3 C's. It's character, capacity, and capital. Character, by and large, is credit. It's not a judgment on you as a person, but it is a judgment on how you handle your liabilities and your obligations throughout your adult life. And that's your credit score and your credit profile. Your capacity is how much you can afford. And it's really how much we think you can afford, because ultimately we run off of ratios that are consistent for every applicant. We don't pick and choose who we let borrow more than others. It's based on percentages of income and liabilities and debts. And then capital is down payment, closing costs, reserves in many cases. A lot of times, depending on the program and the product, you need some money in the bank when the dust settles and all is said and done. We're not going to let you get into a house with your last dime because of all the things we saw on the prior slide that you're going to have to pay for once you get in there. So we're going to go into each of these in detail. So let's start with character. So as I said before, this is not a personal judgment. This is based on widely accepted practices in the art of lending in the United States of America. And it's, for better or worse, largely dependent on that credit report. Let's talk about credit reports for a second. FICO, the Fair Isaac Company, are the folks who created that original credit score. And they're the ones that hold the keys to the castle regarding the credit score. They are the most conservative algorithm for credit that's accepted by the majority of lenders in the country. So when we pull your credit, it is oftentimes more conservative than any of the other systems you may use to track your credit score. And I'm talking about the Credit Karmas of the world, the Discover Card, free credit reporting system. All of these things that have become really in vogue in the past couple of years are a terrific way to track trends on your credit. In other words, if it's tracking with a certain score every time you log on to the Karma app, and suddenly you log on one day and it's plummeted, and you haven't changed your behavior any, then you know something's going on. Something was misreported, or unfortunately, maybe someone got a hold of your credit. So those things are great to follow the trends. But when it comes to the actual credit score and credit profile, we rely on the FICO score, and that's the only score that will prevail. And if you look in the really small print on those Credit Karma situations, you will see they say right on there, this is not the score used by lenders to determine your lendability. So we go off of the FICO score. But again, if you're following those other systems, that's great. You can pretty much tell if something's going wrong or if everything's status quo. So how is your credit? Do you pay your bills on time? Do you overextend yourself? And there's all sorts of rules that apply here, but generally, You need credit to get credit, right? So we don't all start with excellent credit and ruin it over time. We all start with no credit and build it over time. And that's a big misconception. So people who don't use any credit are no better off than folks who maybe don't have a great credit score, because we're relying on the trend that we can see in your behavior. So if you don't use credit and you use everything cash, there goes Stella. That may very well be fiscally responsible, but it's not going to build a credit score. And unfortunately, you're not going to have a lot of lending doors open to you in that situation. So if you don't have much credit now, I would encourage you to start the process, if you want to buy a home in the future, to start building a credit profile. The best way to do that is to get 3 trade lines. Those could be a car loan, a student loan, and a credit card. It could be 3 credit cards, although that's not as strong a credit profile. It could be 2 car loans and a credit card. It could be a student loan and 2 credit cards. But try to get at least 3 trade lines. And if you've had those trade lines for about 24 months or longer, you will have a really nice credit score, provided that you've made your payments on time every single month. Missing a month here or there is not acceptable, although a lot of people think it's not a big deal. But especially when you're building credit, it will crush your progress in that regard. The other thing about revolving credit is you want to always stay below 30% of your credit line. So if you have $1,000 credit line on a credit card, you never want to charge more than $300. Not one, not even charge it up and charge it down, charge it up and charge it down. Keep yourself at that 30%. Now we have a whole nother seminar on credit, so I'm not going to go into all the tricks of the trade, but those are 2 of the big ones that trip people up. So how long have you been employed? Now this is not reflected on your actual credit score or in your credit profile. But when we're looking at a credit application, a mortgage application, we want to see that you've got some stability built into your employment. Ideally, that you've been in the same job more than 2 years. But if you have jumped around a bit for a better situation, more pay or better working conditions, we want to see that you've at least been in the same industry for greater than 2 years. If you are new in a profession for which you went to college, you're a brand new teacher, but you have an education degree, that college experience goes towards your 2 years. So don't fret about that. That's perfectly fine. But the idea here is that you haven't jumped around, or if you have, you've done it to increase your lot in life, okay? The trouble becomes if you've been driving for UPS for a year and now you're doing something totally unrelated. An underwriter is going to look real hard at that and try to guess whether or not this new career is one that you're going to stick with, because it's so very different than what you've been doing in the past. Now, if you were driving for UPS while you went to night school to get trained for a particular thing, and now you're doing that thing, whole different story, okay? So the 2-year employment is important, but let's put an asterisk next to that one, depending on your situation. And then how long have you lived in the same area? Here again, less important, but we just want to make sure that there's not a lot of transient activity here. You haven't lived 15 places in the last 2 years. Okay, we want to know that we're lending long-term debt to people who tend to be planting roots and staying somewhere for some time. So I would encourage you, to check your credit if you really haven't seen it at all. Everyone is entitled to a free credit report from each of the 3 major bureaus, and they're listed here, once per year. So you could pull all 3 at once for free, or you could stagger them throughout the year, and maybe you pull one now and you see that there's something you need to work on. Maybe you correct that during the course of the year, and midway through the year, you check a different one to see if it's been reflected. You can do all that stuff, and if you want more hints about that, reach out to me. But these are the 3 major bureaus, and if you go to each of their websites, and they're relatively self-explanatory, www.transunion.com, you can order your credit report for free. If you want your credit score, however, that's proprietary to the credit agencies. They are not required to give you that for free, and you might have to pay $7 or $8 to get an actual score, but it may be worth it to you if you haven't done that before. The important thing about these inquiries is that they don't count against your credit score. If you pull your own credit report within the year from each of the 3 bureaus, it does not affect your credit score negatively, because an inquiry by a lender will have an impact on your credit score. If you have really good credit, it will have a very marginal impact. If, however, you have damaged credit, each of those inquiries could have a real true effect on your credit score. So this will give you the opportunity to see your credit without having a lender pull it. Okay, once you tap into any of those resources, you want to check your credit. Again, if you don't pay for a score, you're just looking at the line items and you're going to see that it makes sense. Oh yeah, there's my Chase card. Oh yeah, there's my car loan. Oh yeah, I've had it for that long. And yeah, it looks like I've paid it correctly. Or if it shows that you had a late payment last year and you don't recall ever having a late payment, then you're going to want to reach out to your lender on the car and figure out why they reported you late. One thing we see a lot is if you're in the practice of leasing a vehicle and you turn the one lease in and get a new lease for a new vehicle, a lot of times that old lease, they never close it out. And that's stuck on there as a lingering payment. So you want to get ahead of that stuff and see if there's anything on there before you come and apply for larger lending like a mortgage loan. If you do have balances that are exceeding that 30% of your total credit debt, try to pay those cards down. You don't have to pay them off. Don't spend all your capital to pay them off because you might need that money for down payment. But certainly if it's in your capacity to get it below the 30% of the limit, by all means do that. There's one other thing I want to caution you, and again, I don't want to get into the credit seminar, but if you are in the practice of taking advantage of the zero interest rate cards that we get in the mail all the time, that's perfectly fine, but don't consolidate a bunch of little balances onto one brand new 0% card and max that card out. Your credit score is much healthier to have a lot of little balances on multiple cards than it is to have a high balance on just one, especially if that's a brand new card that you opened for that purpose. Okay. Credit score, the bell curve is what you see here with the colors. 740 and above is really top tier. Anything at 740 and above, you get the best rates in a mortgage lending environment. And then as you can see, it kind of goes down from there. This bell curve has shifted. About 10 years ago, a 680 or better was your top tier. And then a whole bunch of stuff happened, not the least of which was the mortgage crisis of 2007, 2008. And now this bell curve has shifted and there is a lot more expected of borrowers when it comes to credit scores. Okay, so that's the first C. The second C is capacity. What can you afford? So here's the thing. The best thing to do is to figure out amongst yourselves what your monthly budget for housing should be. And I always get a lot of first-time homebuyers who pay rent who say, well, gosh, you know, we're struggling to pay this rent every month. So this is our max. This is the cap, what we pay for rent. But what they don't realize is when you get into a house, your behaviors change. You don't eat out as much because you like, you know, you like your kitchen and you're making meals, that kind of stuff. So your lifestyle kind of changes. So it behooves you to really sit down and figure out, hey, what do we want our budget on a monthly basis to be for our housing? Recognizing the fact that the housing payment is everything we talked about, the principal, interest, taxes, insurance, condo fees, if that applies. Okay. But ultimately, whatever you decide is in your budget may look very similar to what we think you can afford, or it may look very different. If you are a first-time homebuyer who thinks you can spend X amount on a loan, and that amount is more than what we think you can spend on a loan, well, your number doesn't matter because we're going to stop at our number. We know what customers can comfortably afford based on the number, you know, national averages. So we're not going to let you borrow more than we think you can afford, even if you feel like you can. Alternatively, if what you think you can spend monthly on housing is much, much lower what the numbers say we think you can afford, well, maybe you're selling yourself short. Maybe you haven't really put a lot of thought into it. Maybe, you know, maybe you can afford more than you think you can. Ultimately, you have to pay it. So we're not here to put you in a house you don't want to afford, but sometimes people do sell themselves short. So how do we determine that capacity? How do we get to that number? Well, it's based on your income and your liabilities or your debts. And we take all these things you're looking at into account. You know, your monthly pay stubs, W-2s, bonuses, commissions, trends, that kind of thing, and all of your credit-worthy debt. Your credit-worthy debt is stuff that shows up on your credit report. So those are typically other mortgages if you own other houses, car loans, student loans, credit card debt, and personal loans. What you did not hear me say was car insurance, cell phone, cable, groceries, entertainment. That stuff does not show up on your credit report, so we don't use it in this debt analysis, but we do use percentages. So this 43% number you see is for your total debt. We don't want your total debt, housing plus all of your creditworthy stuff, cars, insurance, cars, personal loans, credit cards, and student loans, we don't want that to be greater than 43% of your monthly gross income. That leaves the other 57% of your monthly gross income for, first of all, income tax, maybe 401k if you contribute to your 401k, and then all the other stuff, insurance, cell phone, taxes, etc. Okay? So think about your budget and get a sense of what you think you can afford. And I'm going to show you how to walk through this. You don't have to remember any of this. This is the kind of stuff that you can do with a one-on-one, no cost, no obligation consultation with one of our folks. Sorry, I forget where the ends of these slides are. So here's what you can do. Add up your monthly creditworthy debt, the stuff that's itemized here and what I just mentioned. Divide that number into your monthly gross income and then convert that to a percentage. And you want that percentage to be less than 43%. So let's walk through an example. Let's say you have a car loan for $250 a month, a student loan for $135, 2 credit card debts totaling $170 or so. So your total debt on a monthly basis for credit-worthy items is $555 a month. Your monthly gross income is $4,000. Well, $555 divided by 4,000 gets you to 0.138 if you're following my cursor, which is a debt ratio of 13.8%. And that's really, really comfortable because that's much lower than 43%. Well, the difference between the 43% and the 13.8% is your capacity to buy a house. It's your capacity to increase your debt per month with a housing debt. Okay. If you're renting right now, you notice we didn't use your rent payment in this analysis because the idea is if you buy a house, you will have moved out of your apartment. So now we take that $4,000 income, we multiply it times 43%. So now we're working the numbers in the back in the opposite direction. That says that you can spend $1,720 a month on your total creditworthy obligations. Well, we already know that you spend $555 a month. So that leaves $1,165 a month. That's that gap I talked about between the 13.8 and the 43%. So now here's where a first-time home buyer says, oh my gosh, we spend $1,500 a month on rent right now. $1,165 would be no problem. Or the first-time home buyer says, oh my gosh, we spend $900 on rent right now. Where are we going to find $1,165 to spend on housing? Well, we're not telling you you have to find the $1,165. We're telling you that based on national averages, you have the capacity to spend that much on your housing, but we don't want you to spend that if you're not comfortable with it. Okay. So what does this mean? Well, out of that $1,165, you have your pity stuff. You've got your taxes. Let's say they're $400 a month. These are property taxes. You've got your homeowners insurance. And let's say you put less than 20% down. So you have that mortgage insurance that we talked about earlier. Well, if you subtract the 475 and 65 out of the 1165, that leaves you with $625 left for the actual mortgage, the principal and interest. Well, how much does that buy you? $625 amortized over 30 years on a 30-year mortgage at 4% is $131,000 worth of loan amount. So that's how much we would lend you in this circumstance. If you have down payment on top of that, you would add that to the 131 and you would get your sales price by adding your down payment to the 131. This is what we would lend you, the 131. Now, the good news is interest rates are at about 2.8 right now for a 30-year fixed mortgage for someone with good credit. So at 2.8, your lending capacity, if nothing else changes, increases dramatically. And just for fun, let me do that calculation for you right now, just so you can see how these things move around. Because right now, rates are historically low. So all things being equal, at $625 a month, at 2.8% over 30 years, the same payment would buy you $152,000 worth of loan. So you just got $21,000 more because interest rates are so much lower right now. Okay. So that's how that math works. And that's your capacity portion of the presentation. The third C, and again, if you were to call us up and want to sit with us and talk about your situation, that's what we're going to do. We're going to say, bring your pay stubs. If you're self-employed, bring your tax returns. And we're going to do that analysis. We're going to pull your credit for free if you're at the point where you want us to do that. And then we're going to tell you, here's how your numbers add up, and here's what a payment would look like, and how does that feel? Capital. This is the money that it takes to get into a house. Savings is very important. Even if we put you into a first-time home buyer program that allows you to finance 100% of the purchase price, because those are still out there, those programs, even if we were going to do that, you still need to have some money in the bank or in a retirement account, something that you can fall back on if you should need it. We don't ever want to own your house. We're not in the house owning business. We want to keep you in your house, which means that we're not going to force you to use your last dime to get into it, okay? Typically, when all is said and done, after down payment, closing costs, etc., you need a couple of months of your new payment in the bank as reserves, otherwise we won't approve you. So that's important to note. Okay. So let's talk a little bit, before I move on to that, let's talk a little bit more about down payment. The ideal situation is that someone comes to a purchase with 20% down. And that used to be the way everybody had to come to a purchase. And then about 3 decades ago, a cottage industry popped up called mortgage insurance. And what happened was these insurance agencies popped up and they said, hey, Mr. Lender, Mr. Bank, we will insure you against loss if you let people get into houses with less than 20% down. And that's what we do as a matter of course now. When we talk about a 3% down or 5% down or 100% financing with nothing down, we're buying that insurance policy that will help us secure our investment in you as a homeowner who has less skin in the game than the full 20%. So you don't need 20% to get into a property. If you did have 20%, you would be able to buy that home without the mortgage insurance, so it would be a more economical way to buy the house. But any percentage down, 5%, 10%, 15%, or 0%, provided that everything else is in line, credit and otherwise, there's a home for you typically to be able to finance a house. Okay, let's talk about getting pre-qualified. So you're going to hear the terms pre-qualified and pre-approval tossed around. A pre-qualification is literally, we have a conversation. We may look at your credit, we may not. We may take your word for your credit. We may look at your pay stubs, we may not. We may take your word for how much you make. But that's only as good as it sounds, as good as your word. And it's not that you're trying to deceive us, but sometimes you don't know what your credit score is. In my experience, folks with really good credit think they don't have great credit. And folks with really bad credit often think they have better credit than they do. So it's a guessing game. Nobody knows what the algorithm is. It's a guessing game. But a pre-qualification is just that we've just talked to you and we've done some number crunching. A pre-approval is that we've verified your information. We have pulled credit. We have looked at your pay stubs. We have looked at your W-2s. Then we can say to a real estate agent with confidence, hey, this person's a good risk. You're not wasting your time if you get them in your car and drive them around on a Saturday looking at properties, okay? So you want to talk to one of our folks to get pre-qualified at the very least, but more importantly, to get pre-approved. And again, no cost or obligation to that, but a pre-approval does come with a credit search, so you will have that pull on your credit. In order to do that, you're going to need proof of income, so start collecting your pay stubs or know how to get them digitally. That's how most of us do it these days. Savings, proof of your bank accounts. So we need full statements of your bank accounts for 2 or 3 months. So when I say full statements, I mean all pages. If it's page 1 of 18 and you bring us 6 pages, we can't make the determination off of that. We need the full statements. And then documentation of other expenses. If you do pay child support or alimony, we need the court documentation that specifies how much you need to pay. We can't take, canceled checks or something that you gave the ex-spouse, because that doesn't show us that you're paying your full obligation. So we need to see what the full obligation is. So we're really gonna poke and prod into your whole financial situation and really give a sound pre-approval. To the extent that we can't do that we can't get the answers to these questions, then we really can't do the work that you've hired us to do and give you the sound pre-approval, because so much is based on this stuff. So let's talk about products. At Chelsea Groton, we run the gamut. We have products for pretty much every want or need. We have your straight financing, which is your 20% down, or even your 10 or 15 or 5% down. Those require mortgage insurance, as we talked about, but they're still conventional, regular, off-the-shelf products. We use all of the government options, CHFA, FHA. This is kind of alphabet soup if you're looking at the screen right now. These are all different organizations. CHFA is the Connecticut Housing Finance Authority. We use their product a ton at Chelsea Groton. FHA is the Federal Housing Authority. VA is the Veterans Administration. USDA is U.S. Department of Agriculture. All of those products are low down payment products, and we can get you into houses with very little money out of pocket. In addition, we have down payment solutions as well. We have some additional loan products where you borrow the down payment and you pay it back over time. Or we actually have grants. The Equity Builder, the Smart Moves, those are grants where if you're in the house for a certain period of time, typically 5 years, you never pay that money back. And in 2020, we were able to secure over $150,000 for several borrowers in aggregate. Several borrowers got a little piece of that 150,000, and we helped folks get into houses with money that they'll never have to pay back. So those are really important things, and all of our loan officers are versed in all of these programs. So once you get your pre-approval, well, now's the time to engage a realtor and start looking. If you've looked online, that's great. Now it's time to step up that game if you're interested. You know, you don't want to get your hopes up and start looking too heavily into properties until you've done the financing work. Because I don't care what house you fall in love with, if you can't afford it, you can't buy it. And unfortunately, after we've seen the house that we love that we can't afford, nothing else looks quite as good. So don't set yourself up for that. So with the pre-approval in hand, now you want to secure a real estate agent. As the buyer, you don't pay a real estate agent. So there's really no circumstance under which you would not want to engage one. They have access to more listings than you do, even if you're on all the search engines looking for properties. Not only that, if you get hooked up with a realtor who has a real following, oftentimes they have properties in their back pocket that aren't even listed yet that they know people want to sell. So getting a realtor is a good idea. And going to one having done this due diligence is really, really important, because they now know that you're serious, and they're going to get you in their car as opposed to someone else who may not have done this work. The other part of this is, with the hot market right now, with the way properties are flying off the shelves, a seller is not going to waste their time with an offer that is not backed up with a pre-approval. They just aren't. They want to know that the first bid they accept is one that's going to close. They don't want to be shopping for a buyer in this market because they don't have to. So this stuff is important. Again, you know, all the stuff that you think about when you think about your dream home is important here. Location, school districts, type of style of home, the amenities, the proximity, property taxes. You know, I'm in a situation in my life where we're in our move-up home. We bought our starter home. We lived in it for 12 years. We're in our move-up home that will provide the size and the neighborhood for our family until our kids are out of high school, college, maybe. We know that this is where we're staying. But there was a lot of things on our must-have non-negotiable list that became negotiable real quick when it was paired against other things that the house had to offer. So make your non-negotiable list, but understand that flexibility is key when you're looking for a property. The other thing I would caution people on, and I've only started doing this in the last couple of years, if you watch a lot of HGTV, which I do over the shoulder of my wife, that's my way of admitting that I'm not the one really watching it, she is. But if you're watching that stuff, none of the improvements these people make to these houses can be done on the budgets that they announce in the show, right? So we love the idea of finding, maybe a bruised home that needs some TLC, that kind of stuff. But please have realistic expectations as to what you can do with a home, because a lot of those shows are very misleading. I get fired up every time I watch them, and my wife has to walk me off the ledge. You cannot remodel a kitchen with the beautiful appointments that they use in those shows for the prices that they quote in those shows. So just bear that in mind as you're shopping for your house. Find something that's going to suit you. And unless you know how to swing a hammer yourself, get one that checks most of your boxes. So when you find the perfect home, Your realtor will make you an offer. And until that point, the only work you've done with us is that pre-approval. You can't apply for a loan until you're under contract. You cannot lock in an interest rate until you're under contract. In years past, we used to have things in the industry called lock and shop, where you could secure a rate today because you knew it was nice and low, and then you'd have 6 months to find a house. Well, those days are long gone because the market moves so curiously lately in the last decade or so that no bank can take the risk of long-term locks while you shop for your house. So you have to get under contract with the house you're going to buy before you can come back around and apply for your mortgage and lock your interest rate. But you don't want to dawdle once that happens. Once you have your signed contract is when you really want to get your application submitted and get your documentation into us, because the typical mortgage is a 30 to 45 day process from application to closing. There's a whole lot of stuff that happens in between. The first of which is our underwriting. So we need all that documentation, and to the extent that you don't have it all, we have to wait for you to get it to us. But then you've got title work that has to be done by an attorney. You've got an appraisal that has to be done. And in this market that's pretty frothy, the appraisals are taking longer. The title work is taking longer. So once you find a house, reach back out to us and let us know, and let's get the ducks in a row really quick. If there are no realtors involved, if you find a FSBO, a for sale by owner, or if you're buying a house from a neighbor, family, or friend, and you're not going to use realtors, that's okay. But you do need to get an attorney involved beforehand to draft the contract. A contract off the shelf at Staples is not going to cut it here. You need an attorney to draft the contract, and then you'd get us back involved. You will need an attorney to close your loan. Connecticut is an attorney state, so that's all part of the mortgage process. But if there are no realtors involved, you need to get a hold of an attorney early, and you can ask us for how that process works. And then finally, there are a lot of costs associated with getting a loan, which we don't go into in this seminar, but closing costs are a reality. And there's something that's not involved in the closing costs at all, but which 99% of borrowers spend money on, and that is your home inspection. The home inspection is where an inspector walks through a property with you for about 4 hours with you present, and it's part of the purchase process, and you determine whether or not there are some deal breakers as far as the property condition. And that's going to run you $300 to $600 depending on all the add-ons that you choose. That's not part of the mortgage process. We require an appraisal, which is 15 minutes at the property without you present to determine value. But the inspection is something that's outside of the mortgage process, but that your realtors will be involved in. So how do you set yourself up for success? Follow the tips that we talked about tonight. And again, there's a lot more to it than just what we were able to cover this evening, but follow the tips given. Identify credit concerns. So if you've never seen your report, either have us pull one as part of a consultation or go to those credit bureaus and get your credit report and make sure there's no anomalies in there that you have to work on. Start compiling your paperwork. Know how to find your pay stubs. Know how to find your W-2s for the past 2 or 3 years. Know how to download your bank statements so you have an actual statement to work with as opposed to screenshots of your running balance, okay? If you haven't looked at your divorce decree in some time, know where to find it so that you can show us the alimony and child support, whether you pay it or receive it. Because if you receive it, that's part of your income. And then finally, like I say, speak with a mortgage professional. We can do a pre-qualification over the phone through a quick interview, or we could do a full-blown pre-approval. Again, no cost or obligation. We can do it all virtually now. We can do everything via Zoom like we're doing tonight, or just a phone call. And then we can send you a link to a secure portal. You can upload the documentation that we need, and we can turn that around very quickly, oftentimes within a day. But I will caution you, don't wait till Saturday morning when you're looking at your dream home Saturday afternoon to get in touch with us to do a pre-approval. We want to be able to do our work and to give you a pre-approval so that you can make a bid on that dream home. So try to start this process early in the game. All right, that was a lot of information in a short period of time. I don't even know how we're doing on time, to be honest with you. I don't have it up on my screen. But I suspect we have time to answer questions. So if you have any, or if Miria, if you've received any chats along the way, let's try to address those.